I think it's just that, when I speak to companies and talk to people in the market, I think what people perhaps don't necessarily realize is that there were a lot of excesses built up in the system. And prior to the interest rate repricing environment that we went through, companies weren't laying off anybody. And so we went through COVID, we went through the post-COVID era where companies weren't laying off anybody, at least, in terms of a normal perhaps cycle. And so I think we're catching up with that.
Will Rhind returns to the show. He is the CEO of GraniteShares. We're going to be talking about the markets and tech stocks in particular. First, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space. If you're over 18 and you'd like to open a new account with cash or roll over an existing account, click on iTrust.capital/David in the link down below to learn more and learn how iTrust offers unique tax benefits as well, with cryptos rising, especially Bitcoin going up to above $50,000 a coin. You may not want to miss out on this opportunity. Welcome back to the show. Will, always good to see you. GraniteShares has been killing it with some of your funds. We'll talk about some of your funds and the performance. Thank you very much for being back.
David, thank you so much for having me. Pleasure. Always good to see you. I'm glad to be back.
Thank you. Let's start with the overall tech landscape. Layoffs are happening across the board. I mean, not in huge numbers, but we're seeing news pop up of a lot of companies laying off workers for various reasons. Is this a systemic issue? In other words, is the entire industry going through a sort of a bump right now, or is this company specific, just kind of trimming the fat, so to speak?
Yeah, it's more of the latter, David. I mean, I think in this particular environment, what companies have realized over the last 12 to 15 months or so is that, hey, stock market and investors are going to reward you if you show good profit margins and good discipline. And that's really what's been happening. So a lot of the companies, remember, these companies are still growing, very strongly in the case of some companies like NVIDIA, et cetera. But where we see layoffs, I think this is much more just about getting rid of perhaps some excesses that were in the system, focusing on efficiency, focusing on margin. And specifically for companies like Meta, that's really been the right thing to do, and the stock has popped, massively over the last 6 to 12 months.
And if you were to analyze the macroeconomic landscape and perhaps even the interest rate environment we are in today, which we'll talk about in a bit more detail, do you think more layoffs will come for the tech sector later this year, Will?
I think that's right, David, because again, it's not because the tech sector is doing badly. If anything, it's the exact opposite. I think it's just that, when I speak to companies and talk to people in the market, I think what people perhaps don't necessarily realize is that there were a lot of excesses built up in the system. And prior to the interest rate repricing environment that we went through, companies weren't laying off anybody. And so we went through COVID, we went through the post-COVID era where companies weren't laying off anybody, at least, in terms of a normal perhaps cycle. And so I think we're catching up with that. The other elephant in the room, David, that's worth talking about, and I think it's happening certainly with some companies, is that there is a massive move to AI. The race is on. Companies are figuring out now how they can replace, certain headcount with AI, and or just focus investment, i.e. R&D, et cetera, on AI, as opposed to perhaps other areas of the business that just aren't as profitable or aren't as, good for the bottom line. So that is going on as well. Some of these layoffs are AI related, and we'll expect to see more, obviously, as time goes on.
How is AI going to contribute to changes in the labor market exactly?
So in terms of the company's investment, I think, look at things like Microsoft. You look at clearly companies like NVIDIA. Companies are pushing AI strategy and therefore need to fund that strategy. So part of that is, really zeroing in on the investments they're going to make over the next few years that really matter. Meta is another great example of that. And then obviously, if there are productivity gains to be made, not just from the investment, but from AI technology more broadly, that can have an impact on the workforce.
Do you think the markets, in particular tech stocks, have priced in all the rate cuts already?
It's hard to say. I think that you'd have to accept that the market is always pricing in forward rate cuts in terms of how they're scheduled in terms of the Fed fund futures market. And it's the surprises or the deviations to that which typically get investors, more excited or not. So, with the last, hotter than expected, I should say, inflation prints over the last week, we've seen a little bit of an adjustment to that. But for the right companies such as NVIDIA, it hasn't really affected the stock.
Yeah, let's talk about NVIDIA. The company has been exceeding expectations all across the board all throughout last year. The stock has defied not just gravity, but expectations as well. I remember when it was trading at around $500, people were calling it a bubble. Now it's well above $700. Clearly, this mania has extended beyond just a mania phase. It's now a full-blown bull rally that lasted more than a year now, Will. What do you think has been the primary catalyst, fundamentally speaking, behind this rally?
To me, it's all about AI, and it's just the incredible sort of sense of excitement. It's the number one theme in tech, across the board. Everybody's scrambling to get exposure to companies that are leading the way in AI, and clearly companies that are going to be the winners in the race to AI. And NVIDIA really is the poster child for that. So this is all about AI, and clearly, so far at least, I know when earnings are coming up on Wednesday next week, but the company has been more than delivering in terms of revenue and expectations from the performance in AI.
Well, what exactly happened in the last 2 months? That was exponential growth in a very short amount of time. In the last 6 weeks, actually, since the beginning of the year, it went from $480 a share to now $739 as we're speaking today on Friday.
Well, I think the big concern coming into the end of last year, which weighed on the stock a little bit, was the export controls that the U.S. had placed in terms of China on the GPUs and of important or critical technologies. And NVIDIA came out before the end of last year announcing that they basically found a way around those, or found a way to export chips to the Chinese market that were in compliance with the U.S. export rules. The stock ripped off the back of that, David. And then for really, I'd say the first few months of this year, its expectations around this earnings, result, or the fourth quarter, I guess, coming up. But I think more broadly, people are just excited about the prospects for AI and really trying to get exposure to the theme, again, of which NVIDIA has been leading the pack.
Right. Trailing 12-month PE is 97. It's high even by tech standards. Is that, when someone gives you that number, what's your first impression?
I think it's easy to look at the numbers kind of in isolation and say it's high, but it's always relative to what. And, you've got every single analyst on the street talking the stock higher. I think with the exception of the 39 analysts that cover NVIDIA permanently, I think only 4 are at neutral, certainly no sellers, and everybody's at a buy. And some of the announcements, I guess, that have moved the stock, including today, is influential analysts have come out talking the stock a lot higher than where it is today. I think one well-known analyst today even was talking stock 65% higher from where we trade today. So people are incredibly bullish on it, and I think again that's the fun of people's excitement around the theme for AI.
You look at these darling tech stocks that have persisted throughout history. Most of them have not lasted, a few exceptions, of course, now the Magnificent Seven stocks. Do you think NVIDIA is going to be the next Google or Apple or, a major giant in the tech field? Yeah.
Funny, it already is. It already is. We were sat there thinking, when is NVIDIA going to go past Amazon?
Right. Yeah.
As the, fourth largest company in the US, it did it, and now it's gone past Google, which is the third. So it's already there, David. It's already a colossus. It's already in the Magnificent Seven. And I think the difference with NVIDIA is it is a company that's been around for a long time. It's not, one of these kind of overnight darlings that you can perhaps say is a flash in the pan, and this is a moment in time whereby, it's going to be a fraction of the size in a few years. So a lot of it, again, underpins on the company's core growth story, but right now it's competing with the best of them.
What are your expectations for the upcoming earnings release?
I think in terms of the upcoming earnings, I think the earnings are going to be positive. I think they're going to outperform again. I just think there's so much momentum behind the company at the moment. And, for next Wednesday, I think part of the reason why the stock has been bid up so much, and even on a day like today where it's fairly muted market performance, if not slightly down. For NVIDIA to be up again, I think the signal is strong.
Yeah, it's it's just funny how that works. If the stock keeps beating expectations, eventually these expectations are going to be raised, right? And then it's going to become harder and harder to be going
That's
forward.
Exactly. I mean, and you used a great phrase earlier, which is defying gravity. And at the end of the day, that has to catch up to companies because no matter how well you perform, the expectations also adjust to that performance. And that's what's been so amazing so far is every time the expectations have adjusted higher, the stock keeps outperforming.
Yeah, everyone's using the NVIDIA chips, even automakers. Do you see any competitors on the horizon that may take its place?
Yeah, absolutely. I don't know. I don't think we can say take their place, but certainly what's happening, and this is the reason why companies like Taiwan Semiconductor have gone to all-time highs. That's why AMD, excuse me, is massively sort of one of the competing stocks or in the pack there, along with NVIDIA, is because not just that these companies are doing well in the back of AI, but people also want competition and clearly want to have alternatives. Google's chips as well playing a part here. So it's really a healthy story, but the fact that these other companies are doing well, David, is not just NVIDIA. I think shows you how strong demand really is for these AI technologies.
Okay, moving on to another sector, the auto sector, Tesla in particular. The Magnificent Seven stocks moved in tandem last year, not so much this year. Tesla has been a laggard of this group. What's going on there? Well,
just I think really, really poor fourth quarter for Tesla, clearly as a pure manufacturing business for the most part. At least the bit that everybody likes to talk about, specifically on the bear sort of side of the story. China's been challenging. We all know that the Chinese economy is going through a rough patch, and so demand is softer there. And I think the big question really on everybody's mind is it just China, or is it actually a slowdown in EV demand? Is the unthinkable about to happen, which is a slowdown in EV demand more broadly, which clearly up until I would say the last sort of month or so has always been kind of assumed that it was a one-way train, at least for a long period of time.
And with the launch of the Cybertruck that came out recently, it hasn't really done much to the stock. It seems just from observing from the outside, well, that new product releases from the company aren't doing a lot to propel company valuation. Is that a correct assumption?
I think in the case of the Cybertruck, and probably with any new launch, David, I think that's exactly right. That the pre-order or the order numbers alone are probably not going to make a difference at the margin. It's the actual number of units produced and sold that ultimately people will focus on. The delivery book for the order book, sorry, for Cybertruck is incredibly strong, and so there's that's a big growth lever that the company can pull, but to deliver on that, to ramp up production to the levels needed to meet that demand will really be key, and that will be a part of the EV demand story again for this year, the growth numbers.
I remember 10 years ago, people were, I guess, half joking about how to value a stock like Tesla, in particular Tesla. It was this hope that it would become this revolutionary company that would change the world, and in many ways it has. I don't know if that's still the primary metric, hope, in someone's DCF model for Tesla today. But if you were to model out Tesla, what assumptions would you need to be putting in for the stock? Are you primarily focused on production numbers, like you said, actual delivery? Are you focused on new product releases, Elon Musk's vision? What goes into the value of this particular stock is my question.
Yeah, I mean, it's all of the above and more. And David, this company hasn't been valued as an automotive company really since the beginning, and that's why it's created such a strategic advantage and why it is so unique. Because if you look at the valuations of other automakers, Tesla lapped those guys a long time ago, and so the value of Tesla is worth a lot more than your traditional automaker. So if Tesla was valued as a traditional automaker, and that is, in essence, the classic bear case for Tesla, then the value should be significantly lower. And that's why you hear a lot of chatter about the company being overvalued and people looking to short, etc. But if you look at the bull side or the more positive side of Tesla and look at the valuation even today, the valuation has to be more than electric vehicle production or vehicle production just more broadly. And clearly what goes into that thesis around why the extra valuation is all the extra value that a company like Tesla brings, both in terms of battery technologies, in terms of the supercharger network, in terms of the potential for self-driving, for AI, for robo-taxis, all these other things which haven't really quite materialized yet, with the exception clearly that battery technology is a real thing, battery storage is a real thing, and obviously we're looking at the progress being generated around self-driving technologies. But that is the sort of the future for Tesla. And ultimately, as Elon Musk keeps talking about, it's the AI potential, for the company that owns and controls so much data around driving.
Yeah. So the value here is in the data that it owns. What will it do with the data? Export it, sell it to third parties?
I think again, you've got to think about it's the electrification of everything story. And in that, it's Tesla's world and every other car company's just living in it. And so it's really just been able to achieve so much scale and such a dominant position that, with all the cars available, if they go to self-driving or automated AI technology, the opportunity for robo-taxis, things that we just haven't really or can't really conceive at this level yet because it hasn't happened in terms of what that possibility might look like and therefore what the demand might look like and ultimately the profitability.
Yes. Let's switch gears now to another sector or company that you cover. It's Meta. You have a Meta product as well. Meta AI has been launching new products left and right. It's recently introduced a new multimodal language model. It's just making inroads into the AI space. How is Meta, a social media company at its core, adopting AI? What is their core strategy here, you think?
I think the core strategy remains, frankly, what it has been for the last, perhaps since forever, which is selling ads. That's the core strategy. But to be able to do that more effectively, to be able to monetize the data that they have, to be able to sell ads more efficiently, to drive user engagement, I think that's the AI opportunity that certainly Mark Zuckerberg's talked about, within the company. They believe still clearly the metaverse, but I think those ambitions have been pared back a little bit versus clearly the much bigger opportunity, I think, for AI, and especially for a company like Meta with so much data that can be used to really drive further gains.
Are you surprised at how well the stock has done despite so much competition from other social media platforms that are just have been actually for the last decade taking market share away from Facebook? I know Meta owns a lot of different platforms, but let's not forget they started off as Facebook, but the stock has defied that seemingly loss of market share, right?
I think to a certain degree, I think there's an argument that you could say you've been surprised by the performance of the stock. But that's only in the context of, I think, where it came from. And so clearly post, 2022,
yes,
back at the all-time high, pre-pandemic, high for Meta, no one was talking about Meta being overvalued or, there'd been an issue with the company, but there was a massive realignment with expectations, and it ended up famously with, I think it was Jim Cramer who was crying, on air with CNBC right at the bottom, sort of telling people that he made a mistake and that Meta's performance has been so bad and wouldn't invest in the company. And that sort of, not that exact moment, but around about that time was the real turnaround, and where Meta went from a company that probably had the luxury. I mean, this company has always, printed money, literally and metaphorically, and has been a huge growth engine. But they probably had the luxury of being able to focus on growth without the cost discipline that many other companies have to go through. And so when the Fed raised interest rates and the market repriced, then Meta was, I think, to this point, is really the best example of a company that has pursued cost disciplines and efficiency over, apps growth at all costs, and has just really turned that story around from an investor perspective so much that, what do companies have to do at the end of the day to meet investor expectations is the revenue on a quarter-on-quarter, the earnings on a quarterly basis has to outperform market expectations.
Right.
And through the cost efficiencies that we talked about, the layoffs, the focus on the bottom line, the getting rid of projects that weren't serving them well, that company has roared back because it's a massively profitable and growing company.
If someone were to ask you the value proposition or I guess investment philosophy behind a large tech stock, I mean, every sector or stock has kind of a philosophy or a thesis behind it. If you buy, let's say, a gold company, you're probably hedging against inflation or protecting against some sort of economic decline. If you're buying a utility company, you're being defensive. If you're buying, let's say, a dividend company, you're playing on the cash flow, so on and so forth. Why would you buy a large Magnificent Seven tech stock is my question.
So at the core, it's a growth story. It's about buying growth, and that is the core reason. Absent financial reason, absent of what the company does. And like you said, the companies are typically split into growth companies or value companies, and growth companies are absolutely where the Magnificent Seven sort of lie.
So if I wanted growth, well, why wouldn't I go to the small cap tech companies or even venture into, I guess, if I were a PE fund, venture into the startup space? But I guess that's not really in the purview of most investors. But you understand my question, yeah.
Well, that's exactly what people were doing, David, and certainly in an environment where zero interest rates and massive liquidity and almost limitless liquidity. That's exactly what happened. And it wasn't that the Magnificent Seven stocks weren't growing. Clearly they were growing, but people were trying to pursue higher growth or better growth stories in smaller companies and indeed in the startup and the venture world. But we're now in a different world. We're in a world of 5% interest rates. And a lot of those trades, which worked in a zero interest rate and high liquidity environment, no longer work. And that has been the big story of the last couple of years. And the reason why, maybe somewhat ironically, but the reason why the Magnificent Seven stocks have stood out so much is that, yes, they're growth stocks, but these are almost trading in terms of the highest quality stocks, period, regardless of whether you classify them as growth, whether you classify them as value, whether you classify them as tech, whatever. These are the most valuable companies in the world. And, they have attracted a quality premium as well because of that it's not just about growth, it's growth, but growth that is sustainable, is producing huge margins and, beating earnings expectations. And that's not the same for a lot of the small companies. And the small companies, a lot of the growth story has been, completely altered by high interest rates. A lot of these companies, especially if they're carrying debt, that it's really hard to finance yourself, really hard to make investments for the future if you're not at that scale.
So it's a growth with quality aspect trade is what you're saying.
I think 100%.
Okay. Would you make the generalization that large cap tech stocks have a better risk return profile than the small caps right now?
Absolutely. This is the time. This is absolutely the moment for the incumbents, that the sort of insurgent story has gone away in this interest rate repricing world that we now live in. And really the hope, and that's why the market is up to the biggest degree so far this year. The hope is obviously with interest rates going down, or expectations that interest rates go down, that the environment for some of these smaller companies gets more positive. But for now, it's very much the time, the moment for the incumbent, and look at the performance of these seven tech companies versus the rest of the market.
Okay. I want to close off in commodities. You have a fund called COMB, COMB. It's based on the Bloomberg Commodity Broad Strategy ETF. It's down on the year. What's in first of all, what's in this ETF? How is it composed?
Yes, this is a basket of the most liquid, most traded commodity futures in the world. So everything from oil to metals to agriculture. Think of it as like the S&P 500, but for the commodity world. So it's broad-based, large basket, multi commodity basket.
Okay, and the primary commodities that have suffered over the last couple of months? What were they?
I mean, really, it depends on exactly what you're looking at, with the exception of gold. The majority of commodities, I mean, oil's come back a little bit, but the majority of commodities have experienced softer demand, and that's really all been, for the most part, the China story. And China's the biggest consumer of commodities, most important player, and so with that softer demand, that has impacted the commodity market. I think I should say that the sort of expectations around recessionary narratives, or the negativity around that, has played a part as well. Increasingly, that's less likely the more the market goes, or the more the market climbs higher. But there has been a bit of negativity around commodities, in my opinion, oversold at this point.
Okay. Oversold. So perhaps value play there. Thank you very much. Where can we learn more about GraniteShares and your work?
Yeah, no, absolutely, David. As always, people can come to graniteshares.com, our website, and follow me on Twitter, Will Rhind on Twitter, and also clearly LinkedIn and other social media outlets that people are familiar with.
All right. Very good. We'll put the links down in the description below. Always good to see you, Will. We'll catch up again soon. Thank you.
Great to see you. Absolute pleasure. Thanks, David.
Yeah. Thank you for watching. Don't forget to subscribe and follow Will and GraniteShares in the links down below.